Hello, very good morning to all and happy Friday. Welcome to today's Daily Dose. I'm Kelvin here again. Very good morning. Happy Friday. Today will be the 4th of October 2024. So before we start our Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. As well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the short-term technical outlook on the broad-based cross asset classes, let's have a recap of the key events, news data release, and as well as their impact on the various respective broad-based cross asset classes first. All right, so yesterday, there's actually this particular news flow that is very related to the FX market. It was actually a very sudden surprise UK publication interview on the BOE Governor Bentley. All right, so let me share with you what Bentley said in this published news article. So it was actually not a public speech where BOE officials were actually pre-announced in their website that they're going to speak today, tomorrow, or the day after. But this is a kind of a interview that was done perhaps maybe about 1 to 2 days ago, and it was published very interestingly before the start of the UK trading session, or before the start of the London session yesterday. That means i.e. before 2 to 3 p.m. Singapore time yesterday. So that causes the dollar to actually spike up against the sterling, and it also create this very firm dollar strength across the board from yesterday in the FX market. So it's very important. So what he did mention over here is that, before I want to give you a bit of context, Bank of England, means the central bank in UK, is one of the major central bank, together with the Australian Central Bank (RBA), that they are still more conservative in engaging aggressive interest rate cuts because of their respective inflationary trend in their domestic economy. And if you look at the past few BOE monetary policy meeting, there's always a little statement around the somewhere around the monetary policy statement, the paragraph where they release after the outcome of every monetary policy decision. They did highlight that they got to move very cautiously in terms of enacting future interest rate cut in UK. Yes, Bank of England cut only once so far. And because of this kind of very cautious approach in engaging future interest rate cut, market participants at that point in time, or in the previous meeting about one month ago, reduced the odds of another interest rate cut in 2024. So that was the stance that's being deployed, or the guidance that's being given by BOE. But after yesterday, very interesting publication of The Guardian. The Guardian is one of the major UK media outlet, published this prior interview which they did with Bank of England governor. He actually raises the prospect of more aggressive rate cuts. So that is actually a totally turn in tonality in their stances, and that actually took shape right before the UK opening session. That means right before London opening session. So this report was released somewhere around 1:30, between 1:30 p.m. Singapore time yesterday, and that causes the dollar to actually rise against the sterling very rapidly and create a firming effect on the other major currency. So this is what happened over here. Okay, let me share with you. Okay, this was the chart. Okay, so at this point in time, okay, yeah, this was the big spike in the dollar sterling over here. You look at over here. So it's actually released in around 1 p.m. Singapore time. You look at the sterling just spike up eventually, and it create a dollar firming impact on the other major pair as well. And bear in mind, since the start of this year, the dollar is actually the weakest against the sterling. So if you look at year to date, right, year to date performance of the dollar, this is a year to date, that means start of this year all the way until whatever current price we see right now, the dollar is still weakest against the sterling among the major currency pair. So it went down as low over here. That was as low as negative 5.19%, okay, at this mark towards the end of September. Then thereafter, you see yesterday's spike up in the dollar against the sterling. After that rather surprise prior interviews segment that's being released or published by the Guardians, which is one of the major UK media outlet, indicating there is a change of stance by the BOE governor to potentially think of more aggressive interest rate cut in UK versus their prior guidance of moving things one step at a time. Right, so that causes the dollar to actually spike up, all right, yesterday against the sterling. That another news I want to highlight to you. Let me go back to the 5-day again. Later I'll touch more about this 5-day rolling performance chart to share with you other insights. So let me touch on other particular news flow that takes shape yesterday. Will be the ISM services PMI data. Why is it important? Because services activity contribute to almost three quarter of US economic growth. So that means any slowdown in the services PMI will indicate a higher chances of a recessionary environment in the US that may have already taken shape or may have already occurred. So if you look at the headline number, the ISM, because ISM services PMI, there's a lot of subcomponent. Now there's new orders, there's employment, there's so-called prices. So if you look at the headline number, the services PMI number actually rose much more than expected. So 54.9. Market is only expecting slight uptick of 51.7 from 51.5 that was printed in the month of August. So if you look at the trend of the services PMI data in the US, okay, give me a minute. Okay, it's hang. Okay, hopefully it does not hang my laptop. Okay, good. Let it open. So if you look at the services trend, it continues to be rather firm, robust above the 50 level mark since July. So yesterday figure of 54.9 for the month of September is actually the highest since February 2023. So if you look at the 3-year trend, okay, it starts to shape a breakout, a kind of a bullish breakout like this from here. Okay, so indicating to us that the services activity in US is still rather robust. Okay, robust. But what's interesting over here is that there's this particular mixed element coming out from the services employment. So this services employment, right, ISM services employment is actually a subcomponent of the services PMI. So like I mentioned earlier, right, services PMI at the top, at the bottom you have various subcomponents like new orders, employment, prices paid. So this employment, right, is actually a survey based, or in fact ISM services PMI or all PMI data is all service based. That means what the index, the data compiler, what they do is they will send out a series of controlled survey questionnaire to various purchasing manager in their targeted company within that industry. So for services PMI, it will send a list of targeted companies within the services industry in the US. So it's all survey based. So ask them what's their opinion on 3 months, 6 months down the road. So they create something of survey. And from there, because they ask them their opinion, what they expect down the road, the near future. So it become a bit of a leading indicator, but it's survey based. As you all know that survey based, whatever people say may not happen. I mean, action speaks louder than word because survey is like word based. All right. So what's interesting over here is that in the services employment subcomponent, the employment component actually contracted to 48.1. So what the respondent in this services PMI survey, the latest one for September, indicated that they are not really that rosy of hiring people in the services industry. So this is based on their opinion, because it's, or else it will be more than 50. Okay, it's 48.1. So if you look at the open up, you look at the trend. Okay, hopefully it's loading. come on. Okay, let's hope that it's not hang, or else it will be very bad. I got to restart the particular browser. That means everything got to be restarted. Okay, good. So if you look at the services employment, right, from July 51.4, it declined to 50.2, and now it's being contracted at 48.1. So a quick recap for PMI data, be it any PMI data, be it the Caixin PMI data from China, or the S&P compiled PMI data, or even the ISM PMI data, anything that is below 50 represents contraction. So it seems to me that number one, the growth has slowed down in August, and September growth become contraction. So what it means that over here is that the survey-based data being posed the question to this purchases manager in the services industry in US is not so optimistic about the job prospect in the services industry in the US. So because of this rather lackluster or weak data point from the services employment data, market participants are still looking for a 50 basis point cut coming in the December FOMC meeting. So what you see over here is that going to the CME Fed Watch 2. So CME Fed Watch 2 is actually a very good tool to use. It's not live, maybe delayed about 1-2 hours. Based on the 30 days Fed Fund futures pricing, what market participants in this Fed Fund futures pricing is expecting the Fed to do in the upcoming series of FOMC meeting. So this is give us a gauge. All right. So far, even though we start to see a very rosy headline ISM services PMI data, the increasing of odds, right, of a 25 basis point cut still hover around 65%. It didn't increase to 80% because of the rather weak lackluster employment subcomponent that has already contracted in the month of September. So if you look at the current rate is 4.75%, so market is now expecting a high chance of 65% to bring it down to 4.5%. So that's imply a 25 basis point cut. Only 35% chance, less than 50 for sure. Market is looking for a jumbo cut of 50 basis point to bring it down to 4.25% in the 7th of November FOMC meeting. So if you look at the implied 25 basis point cut, it didn't change that much from a day ago prior to the release of the ISM services PMI data. Okay, just jump by 1 percentage point. So if you look at on aggregate, where they actually compile the meeting date across forward looking all the way down to 12 months going forward until 29th of October 2025. So here we are, 65 chance of a 25% cut implied potentially to bring the Fed funds rate to 4.5%. So from 4.5%, a 50 basis point cut will bring it down to 4%. So if you look at the next two meetings from 2 months from now, which is I would say that 2 months from now, on the 18th of December 2024, higher chance of almost more than 50%, 70% chance, market is expecting the Fed to rate to be lowered to 4% to 4.25%. So that's actually implied a 50 basis point cut. So what market is looking at over here is that the dovishness that's being priced in by the 30-day Fed funds futures compiled by the CME Fed Watch 2 are still rather dovish, not totally more on the cautious side of the story. Despite that, that means they still expect the Fed to actually continue its interest rate cut cycle, not cut pause, but there will be a chance before 2024 ends, there will be a jumbo cut of 50 basis points. So this is what the market is actually implying now, due to the fact that the ISM employment data is still turned to a contractionary mode. All right. Then now, the next key thing is why dollar continues to remain firm yesterday is due to this rising geopolitical risk premium that has complicated the picture. That means right now, we need to see a lot of factors that at play, macro factor and geopolitical risk premium factor. So this geopolitical risk premium factor arises from the Middle East region, which is very crucial because this is where oil is being potentially produced, and oil could be used as a weapon of choice for bargaining, because we know that if oil prices starts to shoot up too much, several oil importing economies may not be able to actually sustain for such higher oil prices, and it will lead into a problem for US central bank to actually engineer this potential interest rate cut cycle, because potentially imported inflation may come back again, like what happened in 2021 to 2022. Okay, so what happened over here is last night Biden, the current US president, made a remark saying that okay, let me expand. Okay, so West Texas crude oil yesterday pierced past 5%. Still remember that yesterday we turned neutral due to mixed element in the short-term technical chart of WTI crude below that 73.15. So very clearly, yesterday they cleared above this key 73.15 level, indicating there's a high chance of further potential rebound. So later I'll share with you what are the next key short-term resistance level to watch for today. So they actually, the most important thing, because there was actually a change in US stance, because US in the last 2 days, they were actually advocating for a de-escalation of the tension in the Middle East. That means urging Israel to reduce their so-called attacks against Iran and against Lebanon, because what Israel wants to do now is they are on the offensive after taking on Hamas. So now they're trying to actually be on the offensive to attack Hamas allies. Firstly, it's Hezbollah in Lebanon, pardon me, and now they are actually attacking their big brother, which is Iran. So what Iran did on Tuesday, they retaliated with 200 plus of missiles targeting towards Israel, but Israel minimum casualty, and right now Israel has the option to actually totally eradicate Iran nuclear sites, that means preventing Iran from staging future attacks on Israel, and as well as punishing Iran revenue generating oil production capability. So, but 2 days ago, US was actually dissuading Israel from not doing that. But when, very interestingly, when the reporter, a particular media reporter asked President Joe Biden if he would support Israel in attacking Iran's oil facility, then he did mention that we are discussing that, and he think that I think that will be a little anyway. So what he implies over here, it seems to me that there's a change of tonality in the US White House administration, that they are no longer in the negotiation process with Israel to asking them to actually de-escalate the situation. So that causes the region itself, the Middle East region, that potentially in the next few days we could see more hostility, and that causes the oil price to actually shoot up 5%, West Texas crude oil breaking above the medium-term resistance level at $73.15 per barrel. So that, because of this rising geopolitical risk premium, it causes also a flight to safety, where we start to see a dollar remaining rather robust because of this situation over here. And at this point in time, we also start to see gold price also remains rather firm against holding above the key pivotal support at 2,620 per ounce. So if you look at the gold price right now, let me very quickly go to the gold price over here. Okay, so you look at the daily chart of gold, both the medium term and the major trend and the short term trend all remains intact. All right, so gold yesterday put in a positive gain of 1.4%. So it rose for, okay, pardon me, let me go back to the daily chart again. Okay, so yesterday gold, okay, let me expand, go right. Okay, so if you look at gold so far, it has been holding firm against above this Monday low of 2,625. Okay, let me remove this. So this will be a support level here. Okay, holding above, very firm above this Monday low. And yesterday, they're trying to actually shape this curvature. Okay, curvature. So this whatever all-time high that was printed on last Thursday, this considered as a bullish pennant technically in gold price. So gold is also rather firm because of this rising geopolitical risk premium instead. And that actually also caused a bit of what I call uncertainty in terms of the major US stock indices, especially in US. So I could see US in yesterday US trading session on the US stock market, all the benchmark US indices also closed in the red. So there was actually a whipsaw session, almost sideways. So initially S&P rallied in the green, then thereafter it traded sideways and closed in the red by negative 0.17%. The Nasdaq 100 almost unchanged, very volatile, what you call it, undecisive movement as well for the entire week since Monday for all the major US stock indices. So Nasdaq 100 ended almost unchanged, negative 0.05%. The Dow Jones was the worst performer intraday yesterday, down negative 0.44%. And not the worst, the worst was the Russell 2000, down negative 0.68%. So the reason why Russell underperformed is because of the risk that if oil prices continue to spike up from here, and there was actually further hostility in the Middle East region, that means Israel does not stop its so-called aggressive, offensive, tactical military operation right now, potentially we may see oil price continues to rise because oil may use as a weapon of choice, and that could potentially hurt the smaller caps company, because this smaller cap company, they do have weaker balance sheet, and potentially their revenue tends to be heavily dependent on the health of the US economy. And if oil prices are going to rise, that means i.e. Consumer spending in US may start to slow down because of higher cost of living or higher cost of groceries or necessity. So that will potentially will start to see reduced revenue for this small cap company. So that actually explains why the Russell 2000 underperformed yesterday. So a rather we call it undecisive movement in the major US stock indices yesterday. All right, so with that, I've covered much ground on what has taken shape yesterday and their impact on the respective broad-based cross-asset classes. All right, so for today, there is no significant fundamental and intermarket dynamics that I'll share with you guys. So now let us now jump straight to the short-term intraday technical outlook. All right, so on the short-term intraday technical outlook, let me start with this particular situation first. The 5-day rolling performance of the US dollar against the major currency pair as of now. So what we could see over here is that the dollar yen now has starts to reduce its prior short move up seen at the start of Tuesday. Yeah, at the start of this Tuesday, because of that political jawboning from the new Japanese PM urging BOJ not to increase interest rate this year. So that causes the dollar yen to spike up. Why? Because of the upcoming snap election in Japan on 27th October, where the current PM wants his party, LDP, to actually remain its majority sitting in the Japanese parliament by urging more kind of a pro-growth policy. All right, so but however, this dollar yen right now seems to be losing some kind of strength, lackluster, after failure to break above the 146.50 handle. So later I'll touch on the dollar yen technical chart. And the reason why dollar yen is actually inching downwards now is could also be this ongoing geopolitical risk premium that is taking shape in the Middle East, because don't forget, yen is also considered as a safe haven currency, okay, in terms of this kind of geopolitical risk tension. So before that, now this is something that is taking shape right now. So that means, i.e., we will start to see a bit of mixed element right now, a bit of mixed element that is taking shape in the market. Yen maybe as a safe haven bit, and currency that are considered as risk on proxy, like the Aussie dollar, may starts to we call it lose a bit of strength against the US dollar. That means the US dollar may continue to churn up higher against the Aussie dollar, and that also could potentially see the Kiwi being showing a bit of firm strength against the dollar, a bit of what I call weakness as well against the dollar, okay, because the Kiwi and Aussie track hand in hand. So with that, let us now jump straight to the individual chart of the major, as we do every day on the major US dollar pair, starting with the euro dollar first. So with that, let me expand my screen Okay, so now on the euro dollar, what we could see over here is a rather mixed element because the euro dollar also has a close relationship with the sterling pound, and given that the sterling dollar has did a tremendous significant decline yesterday, and the euro dollar doesn't actually make any headway playing around the 50-day moving average. So yesterday we do have a bullish bias holding above the 110 short-term pivotal support because of that bullish divergence that has taken shape on the hourly RSI. And given the fact that because the sterling dollar still remains rather lackluster, at least in the short term, today I have no conviction to maintain that bullish bias on the euro dollar anymore because of its direct correlation with a weak sterling dollar. So with that, I will rather turn into a neutrality stance, taking into account of yesterday's swing high, which is the minor congestion zone here at 110.55. So for the euro dollar, I will flip it to a neutrality stance for today, neutral between 110.55 and 110 figure level. So only a clearance above 110.55, that means an hourly close above it, that we could actually potentially kickstart the potential new recovery phase, at least in intraday on the intraday basis for the euro dollar to revisit 110.90 and potentially even 111.20, which confluence with the 20-day moving average, acting as the next near-term resistance zone as well. However, if price action continues to plunge, that means we're going to see firmer dollar strength due to this further potential escalation of hostility in the Middle East. The euro dollar may continue to show further weakness with an hourly close below 110 figure, exposing 109.45 and the important medium-term pivotal support at 108.90, which confluence with the 200-day moving average acting as a support level as well. So that's for the euro dollar. Turning our attention will be the sterling dollar. So the sterling dollar actually plunged below our support at 132 this 50 132 132.20 132 132.50 slash 132.20 level. It plunged all the way down. So after it hit this level, right, this was the significant decline. So this is indeed a pivotal support. One level break, then it triggered that significant sell-off. So this significant sell-off managed to pause at the next support level that we highlighted yesterday at 131 figure, psychologically and very close to the 50-day moving average as well. Yes, RSI is in oversold, deeply oversold. So this is the most oversold level since in the last 2 months, since August, deeply oversold. But yes, despite it went to a deeply oversold level on the hourly RSI, but there's no bullish divergence. That means no clear higher low. So far it was a lower over here. So with that, no conviction for a recovery at this point in time because no clear signs of a bearish exhaustion has been depicted. That means no bullish divergence on the hourly RSI despite hitting a 2-month extreme low oversold level. So with that, neutrality stance on the sterling dollar. So neutral between 31 figure level, 1.31 figure level, and 1.3160 level. All right, so only a clearance above 131.60 level with an hourly close above it, then potentially we could kickstart a minor recovery scenario unfolding for today, back towards the 20-day moving average acting as a resistance zone at 132.20 slash 132.50. But if price action continues to break down below 131 figure level with an hourly close, then this impulsive downward sequence on a minor time frame sequence will continue to slide lower to expose the next near-term support on the intraday basis at 130.40, followed by 130 figure level. So 130 figure level is our key medium-term pivotal support. So if you look at the daily chart, 130 figure level is rather key. This level here, medium-term pivotal support. Why is this level important? Because this is the former pullback line of this symmetrical triangle range configuration breakout that was kept the price action from 30th of July all the way up to 13th of July last year, all the way up to 18th of July this year. It broke out, retest, bounce, and now it become a key pullback medium-term pivotal support at 130 figure. So in order to maintain this medium-term uptrend, this 130 figure got to actually host on the sterling dollar, okay, on a daily time frame basis. So that's why on the hourly basis, at most, right, if the breakdown below 131 figure level, the next two support level to look out for, at least in the first step, will be 130.40 followed by 130 figure. Okay, so that's for the sterling dollar. Turning our attention now will be the Asia Pacific currency, starting with the Aussie dollar. Still recall that Aussie dollar yesterday we do highlight some bearish element that has taken shape on the daily chart. Why? Because of this 69 key figure medium-term pivotal resistance. Why is it key? Because previously this was the resistance that kept previous rebound since 15th of June last year, and as well as a long-term circular descending trend line from the 25th of February 2021 swing high. So that was close to 3.5 months ago. So price action in the last 3 or 4 days refuses to have a clear break above 69 figure level and starts to shape a series of bearish reversal candlestick pattern. We have a shooting star, we have we call it another what I call small spinning top, followed by a greystone doji. Then thereafter, yesterday we see a negative price reaction from the 3 series of bearish Japanese candlestick hovering at the key 69 figure level. So that led us to flip into a bearish bias yesterday on the Aussie dollar. So Aussie dollar yesterday almost came down to our first support at 68.25 before shaping a lackluster bounce into the Asia session. So our hourly RSIs, no signs of bearish exhaustion because price action continues to stage lower low. There's no bullish divergence and lower high over here. So with that, we will still maintain this ongoing we call it bearish bias on the Aussie dollar, also due to this rising geopolitical tension in the Middle East that potentially could hurt Aussie dollar, because Aussie dollar is also considered, the Aussie is also considered as a risk on proxy in the space of the FX market. So with that, I will have a tighten key short-term pivotal resistance for today, tighten it from 69.40 to 69.10. So what's 69.10? Former minor swing high of 1st of October and 2nd of October, and as well as the pullback resistance of this former minor ascending channel support now turns into a pullback resistance level. So as long as any bounce, given the fact that today is NFP, as well as any bounce did surpass above 69.10 figure level, 69.10 tighten short-term pivotal resistance level, we will still maintain our bearish bias on the Aussie dollar. Break down below 68.25, open up scope to expose the next near-term support at 67.86, which is confluencing with the rising 20-day moving average. If this level can't hold, potentially the next near-term support level may be considered at 67.40, which is the minor support level or the minor swing low level of 17th of September and 19th of September, and also coming very close to the 50-day moving average as well. Only an hourly close above 69.10 will break out above it, invalidates today's bearish bias to kickstart another round of potential minor recovery on the Aussie dollar to seek out the next near-term resistance level at 69.80/70.10 next. Okay, so that's for the Aussie dollar. Turning our attention will be the dollar yen. So dollar yen yesterday returned neutral between this 147.20 and 145.50. So price action hesitant yesterday during the US session as well, can't break out above 147.20. And what's interesting over here is that the hourly RSI has starts to shape a bearish breakdown. So putting in line over here, right, this hourly RSI is like a parallel support level. Okay, parallel support level, it happened, and where the price action trade higher as well. And right now, this parallel support level has staged a bearish breakdown, retest above it, bearish reaction, and shape lower low. So indicating that the upside momentum on the last 2 days has started to die off. And with this bearish condition that's being flashed out in the hourly RSI, we'll flip to a intraday bearish bias one step at a time on the dollar yen using 147.20 as my short-term pivotal support level, but near-term support level will be rather tight. 145.45 first, breakdown below it exposes 144.40, maximum 143.10 for today on the intraday basis, which correspond to the lower limit, the minor swing low of 1st of October and the 20-day moving average acting as a support level as well. Only a price pushback up and an hourly close above 147.20 will invalidate today's intraday bearish bias to see the continuation of this mean reversion rebound within its medium-term downtrend to kind of expose the next near-term resistance level at 148.14/70, which is this area here. Okay, this area here above 148.70, further potential upside, may be seen to revisit the 16th of August 2024 swing high at 149.30. Okay, so that's for the dollar yen. And that actually sum up the intraday technical outlook on the major dollar pair. So right now there is one particular FX cross pair that I share with you all that has some interesting short-term intraday technical configuration is this Euro Swiss. And also Euro Swiss is also considered as a risk on risk off proxy as well. And potentially the Euro Swiss may continues to see further weakness if the rising geopolitical risk premium starts to inch up much higher due to the hostility in the Middle East region. So I could see over here very interestingly, right? This previously I highlighted this Euro Swiss as well. Last week, one of the daily lows using 94.40, pardon me, 94.40 as our short-term pivotal resistance level, and price action indeed actually shaped lower, hitting a low of on this Tuesday at 93.40 before bouncing up. And after this bounce off since Monday, it got rejected again. It got rejected at the 20-day moving average. Okay, got rejected at 20-day moving average, and continues to involve in this minor descending channel for this Euro Swiss cross pair since the high of 25th of September this year. So with that, I'll be still using 94.40 as my short-term pivotal resistance in the Euro Swiss FX cross pair. We also correspond to the 50-day moving average acting as a resistance and the upper limit of this minor descending channel. First near-term support level to watch will be 93.70, followed by this week current low, current intraday week, current intra-week low for this week at 93.40. A breakdown below 93.40 exposes 93.10, which is the minor swing low of 11th of September and the lower limit of this minor descending channel. Only a breakout of the hourly close above 94.40 will negate this intraday bearish bias to see another round of kind of very choppy mean reversion rebound to revisit 94.80/95 figure level, minor swing high level of 20th of September and 25th of September, and as well as this pullback resistance of this former minor trendline support that was previously in place since 11th of September. Okay, so that's for the current intraday technical configuration that is playing out on this particular FX cross pair, Euro Swiss. Okay, so with that, now let us now focus on our attention to the major stock indices, starting from the Asia Pacific Stock Index, which is the Hang Seng Index. So the Hang Seng Index, what you could see yesterday, that yesterday we do have a bearish bias with looking for a kind of a short-term minor pullback scenario heading potentially towards the support level at 20,880/20,590, but price action seems to be rather resilient and managed to stage a higher low instead. That means can't actually surpass much lower to cover the gap up that has taken shape on Wednesday. Okay, Wednesday, this gap up over here, and also the hourly RSI has started to shape higher low as well. So with this failure to actually cover the gap support level, which is our desired support level to watch in that potential minor pullback scenario, price action now seems to be having that potential bullish momentum seeping back into it, at least on a short-term basis. So with that, we got to respect the current price action that has been taking shape right now, higher low on the hourly chart of the Hong Kong 33, i.e. the Hang Seng Index. So with that, we will flip to an intraday bullish bias on the Hong Kong 33 for today on the Hang Seng Index. So the Hang Seng Index seems to be a bit of a outlier right now, not really trading in line with the major US stock indices because of that potential upcoming much more forceful fiscal stimulus policy that very likely got to be pretty much implemented soon by the China top policy makers that potentially could target directly to boost consumer spending and confidence. So that actually explains why the Hang Seng indices is rather resilient at this juncture. All right, so bear in mind the China stock market is still closed for today due to the China Golden Week, and they will reopen on next Tuesday. So with that, back to the Hang Seng Index, we will use yesterday's minor swing low as my very tight short-term pivotal support level, 21,470. Short-term pivotal support level, flip to an intraday bullish bias. Next resistance level to watch above 22,660 will be at 23,550/. 23,670, which is the 1.618 Fibo extension level from the low of 11th of September, and as well as another Fibo extension level at 3.618, taking from the low of 5th of August, and the 23,670 graphically is also this support, this resistance level over here on the daily time frame. Okay, this level here, former minor swing low, no, was it? Yeah, this level. Okay, former swing low now turns support level break, now turns into a kind of a pullback resistance at this level here, which is also correspond graphically at the 23,000 550, 650 level, 670 level. Okay, now back to the hourly chart again. So if price action can't maintain at 21,470, then it will invalidate. That means with an hourly close below 21,470, that would eradicate or invalidate today's intraday bullish bias to kickstart a minor corrective pullback, exposing the next near-term support levels at 20,880/20,590, followed by 19,790 next on the Hong Kong 33. Now, back to our attention to the Japan 225. So no change on the Japan 225, continues to trade within these two important level, 38,620/38,920 level. This morning it hit a bit of hesitance to push up higher. So still no change, still using, that means it will be trading between these two zones. So I'll rather turn neutral for today because since it's already Friday. Okay, so at the upper limit, remove this. Okay. Okay, so neutral for my bullish stance turns to a neutral stance for today because it seems to be a bit of hesitance of breaking above the 38,920 level by looking at the current price action right now. What you see over here is a kind of a shooting star. Then the shooting star, there's a bearish reaction from the shooting star as we are speaking right now on the current price action on the hourly chart of the Japan 225, i.e. Nikkei 225. So with this hesitance by the current price action at the resistance level of 38,920, so we will flip to a neutrality stance for today, neutral between 38,920, lower limit 37,830 on the Nikkei 225 or Japan 225. Okay, now turning our attention now to the German 30 or the German DAX. So the German DAX seems to be playing around at this 19,050 level. So previously, right, we have this short-term pivotal support here yesterday that we highlight. Okay, seems to be playing around this level, 19,050 level mark. And what's interesting over here is that yes, price action shaped a kind of a lower low. Okay, there's a lower low in price action over here, lower low, right? Okay, lower low in price action. Price go lower, but if you look at the same period, the RSI is sloping upwards. Okay, indicating that slowdown in bullish momentum, bearish momentum, obviously bearish momentum. And what we could see over here is that the German 30 has been trading in a rather similar direct correlation with the China and Hong Kong stock market, because given the fact that a lot of German or Eurozone, we call it a corporation, their revenue flow dependent on the China consumer. So for Germany, it's more on the industrialized product itself, okay, that China corporation used to purchase to make their final product. So that actually explain why the German 30 index was actually rather rosy since the late September, okay, moving in line with the bullish price action of the Hang Seng Index and the China benchmark stock indices. And given that the Hang Seng Index has started to see some form of bullish momentum coming back into the picture, and given with its direct correlation with the Hang Seng Index, and the China related stock market, plus this bullish divergence that's being flashed out on this hourly RSI, we will still maintain this intraday bullish bias on the German 30 right now with a slightly we use a new short-term pivotal support for today, 18,820, which is also the minor swing low of 25th of September and also correspond to the rising 20-day moving average. But price action got to break out fast above 19,190. So this is the first upside trigger level to watch potentially. So only a breakout above 19,190 will increase the odds of this intraday bullish bias to potentially revisit the next near-term resistance zone of 19,460/19,550. Only an hourly close below 18,820 invalidate today's intraday bullish bias. So i.e. I repeat, only an hourly close below 18,820 invalidate today's intraday bullish bias to see the extension of this minor corrective decline, exposing the next near-term support level 18,690 followed by 18,510, which is correspond to the rising 50-day moving average. Okay, so now turning our attention will be the major US stock indices. So for the US Wall Street 30, the Dow Jones Industrial Average managed to survive at the short-term pivotal support yesterday at 41,950. But given this kind of lackluster movement and also the risk, it's direct, we call it whipsaw movement due to this uncertainty in the Middle East that causing the upside also to be kept at 42,410 levels since the start of this week. So bullish bias has been reduced on the US Wall Street 30, so I will flip to a neutrality stance, neutral between 42,410 and 41,950 for today. So only a hourly close below 41,950 potentially could trigger a minor corrective decline, at least in the first step, to open up to expose the next near-term support level at 41,535, which also correspond very closely to the 20-day moving average and the lower limit of this ascending channel that I drew from the low of 5th of August. So only a price action hourly close back above 42,410, then the impulsive up move may resume on the US Wall Street 30 to potentially revisit the current all-time high at 42,730. Above it sees 43,170 next. So that's for the US Wall Street 30, i.e. the Dow Jones Industrial Average. What's up for the Nasdaq 100? No change, still continues to be trapped within this sideways range level since the start of this week, or since midweek, since Wednesday. So we'll still maintain that neutrality stance, 20,000 and 19,630. All right, so neutral between 19,630 and 20,000. So only a breakdown below 19,630 will potentially trigger off a continuation of this minor corrective decline scenario, because price action start to trace up a series of lower high, lower low, then thereafter it starts to trade sideways since Wednesday. Breakdown below 19,630 may continue this minor corrective decline in the first step, exposing the next near-term support level 19,380 slash followed by 19,120, which is also kind of confluence with the 20-day and the 50-day moving average on the average in between over here. So now with that covers up the intraday technical outlook on the major US stock indices and the major stock indices globally. So now turning our attention to the commodities market, starting with gold XAU/USD. So I did mention gold continues to hold firm, and yesterday bounced off right exactly at our first support level at 2,640, which also correspond to the lower limit of this minor ascending channel that is in place since the low of 9th of September. So I don't want to put the pivotal support too tight at 2,640, given the fact that today there is also a key risk data that is releasing in the US session, which is the non-farm payroll data. Still using 2,625 as my short-term pivotal support level. As long as this level holds, we will still maintain that intraday bullish bias on gold XAU/USD above 2,674. Potentially sees the next resistance coming in at 2,692, followed by 2,709, 2,715. However, if price action starts to break down below 2,625, then this intraday bullish bias will be invalidated to kickstart a minor corrective decline sequence, exposing the next near-term support at 2,590/2,570, which will correspond to the rising 20-day moving average. Now, turning our attention, next will be the West Texas crude oil. So West Texas crude oil, let me touch on the daily chart first. So on the daily chart, very clearly, right, it broke above the 73,015 level mark and also cleared, have a daily close above the 50-day moving average as well. So now potentially, right, this rebound could actually extend from the low of 67.55, 65.70, potentially kind of revisiting the 200-day moving average at 78.30 slash 80.30 level, which is this kind of a medium-term descending trend line resistance level that is in place since 28th of September 2023 high. In fact, it's major, not medium term, because it's already a 1 year plus of 1 year of trend descending trend line. And also the RSI has starts to be sloping up higher low right now and clear above a parallel descending trend line resistance level as well, a bullish breakout over here, indicating that this downtrend from the high of 5th of July all the way down to 10th of September has been eradicated, and right now there could be a trend change that is taking shape one step at a time. Next resistance level to watch 78.30, 80.30. So this is a daily chart. So potentially this will be more like a multi-week time frame, all right, on this 78.30, 80.30. So what is the lower time frame resistance level to watch on the intraday basis? We got to use the hourly time frame chart. So on the hourly time frame chart, I'll be using 73.15 level. So yesterday we were neutral between 73.15 and 70.10. So any potential pullback now, because the RSI potentially is now overbought and now has reversed from the overbought level, so there could be a chance of a pullback taking shape, because there's no bearish divergence. Price action continues to shape higher high on the hourly RSI. So as long as this pullback didn't surpass below 73.15 level, so this will be my short-term pivotal support for today. We will flip to an intraday bullish bias. Resistance level to watch on the intraday basis 75.07 followed by 77.70 level. Okay, which is this minor swing high area of 30th of August. However, if price action starts to shape a hourly close below 73.15, then this intraday bullish bias will be invalidated to see another round of choppy movement on West Texas oil to expose the next near-term support level at 70.10, which is correspond to the 20-day moving average as well. That's acting as a support level at 70.10, and below it revisit this Tuesday minor swing low area at 68.15 slash 67.45. All right, so that sum up the intraday technical outlook on West Texas oil and the intraday technical outlook on the major cross asset classes. So before we go, let's take a look at the calendar. What are the things to look out for other than the non-farm payroll data that's out in the before the start of the US session today? So today is Friday. So during the European session, there's one very important BOE official speech that's going to take shape. So market participants will be hearing this BOE official speech called BOE Peel speaking at 3:55 p.m. Singapore time after yesterday very sudden about turn of BOE governor so-called interview with the Guardian, where he actually changed his prior cautious tone to be more dovish. So at 3:55 p.m. Singapore time, and there's another ECB official batch speaking at 4 p.m. Singapore time today. Then also another ECB official speaking, Gondos at 6 p.m. Singapore time, and thereafter this will be a much more key highlight, important risk event for today in terms of economic data release will be the non-farm payroll data out at 8:30 p.m. Singapore time. So market expecting a slight dip down to 142k job added. Market is only looking at 140k. So market also be looking at whether the previous figure for the month of August will be revised downward or not, because in the prior 2 to 3 months that figure was revised downward. And also the unemployment rate. So unemployment rate previously was at 4.3%. It ticked up in the last 3 to 4 months. So now market participants will be monitoring the unemployment rate as well, whether it could stay at the 4.2% level, very similar level that was printed in the month of August. So that's at 8:30 p.m. Singapore time, and at 9 p.m. Singapore time, there's another Fed official speaking, Fed Williams. Whilst today we see a series of monetary policy official speaking. So at 9:10 p.m. there's another ECB official speaking, Edison speech at 9:10 p.m. Singapore time. Then thereafter it will be a rather quiet US session, and also market participants will be also focusing on the news flow that is coming out from this ongoing we call it a conflict or hostility between Israel, Iran, and Hezbollah, which is Lebanon, that is taking shape in the Middle East right now, that could impact the risk on, risk off sentiment, at least on a short-term basis. So with that, this is Kelvin here signing off. I wish you all a great and restful weekend, and we shall speak again on next Monday. Thank you.